Good evening, everyone. I am Udal Bhatt, assistant to Professor Varun Sabu. Welcome to Accord Capital Stock Exchange and Practical Strategy Program. Let's have a look at Indian stock market, the whole week performances. As the overview of all the indices, selling pressure intensified again during the week ending October 25th. Influenced by ongoing geopolitical tensions, weak earnings for September quarter, lackluster demand environment and pressure profit margins, and significant foreign institutional investors outflows. The market sentiments was low with all major indices falling more than 2%, making the fourth consecutive week of decline and reaching a 4-month low. This week, the Bombay Stock Exchange Sensex Index fell by 1,822.46 points or 2.24%, closing at 79,402, while the Nifty 50 index dropped by 673 points or 2.17%, closing at 24,180. Starting from the week of October 28, Diwali week, investors will be focusing on corporate earnings and series of US economic data including GDP. Market participants are expected to remain cautious ahead of US presidential elections on November 5. At the close on Friday, the Sensex index fell by 662% or 0.83% to 790,402 points, while the Nifty index dropped by 218 points, while 0.19% with amount of 24,180, as the Sensex index fell by 0.18% in the whole day. And the Nifty on October 25th declined for fourth consecutive days of trading, continuing its downtrend amidst mixed global market sentiments. The index fell below 24,100 points during intraday trading. The Nifty index saw a significant drop during Friday's trading session on daily chart. The Nifty sports level are at 24,100 and 24,000. The index may see a slight rebound or consolidation in next 1 or 2 days. On the weekly chart, the Nifty formed a long bearish candle here and break down from its continuous rising channel, which is not a positive signal. This indicates that the market may continue to face pressure in the short term. However, the strong support around 24,000 point level and probability of market rebound next week is very high. In all the other sectors, Nifty media metals and real estate fell by 7%, Nifty oil and gas is fell by 6%, and Nifty PSU bank index nearly fell by 6%. This week, the Bombay Stock Exchange large capital index and mid capital index and small capital indexes fell by 3.2%, 5.2%, and 7.3% respectively. On Friday, the Dow Jones Industrial Average fell by 259 points or 0.61% with amount 42,114 points. The S&P 500 index fell by 1.74% or 0.03% to amount 508 points, and the Nasdaq Composite Index rose by 103.12 or with percentage 0.6% to amount 18,518 points. And about the top stock news, the Sky Gold's board approved a bonus issue in the ratio of 9 to 1, meaning investors will receive 9 additional shares for every share they hold. The last week market capitalization of 9 out of top 10 companies shrank by total 2,09,952 million, consistent with the weak market trend including Hindustan Unilever and Reliance Industries. The pharmaceutical giant, the Sun Pharma, is expected to report healthy revenue growth in the second quarter, driven by its domestic business, which benefited from favorable and seasonal conditions to growing sales volumes. About the Ratan Tata market, the Nehal Tata faces obstacles in becoming the chairman of Tata Groups, as Ratan Tata established a rule in 2022 prohibiting one person from simultaneously serving as the chairman of both Tata Trusts and Tata Group. And we have some key takeaways to talk about here. That this week, foreign institutional investors continued to withdraw from Indian market, selling stocks worth of 20,024 million. However, domestic institutional investors offset this by purchasing stocks worth 22,914 million. So far this month, federal institutional investors sold over 10 billion stocks, while the domestic institutional investors have purchased stock worth of 97,090 billions. Ongoing uncertainty around US presidential elections keep investors cautious. Investors' bets on a Fed rate cut were dashed by strong economic outlook expectations, causing global market volatility. This week, starting October 28th, is crucial for Wall Street also, being the last week before USA presidential elections. Major tech companies including Alphabet, Google, Apple, Microsoft will report their earnings along with their October US non-farm payroll reports. This week, the Indian market experienced a decline, making the longest weekly drop since August 2023. All the sector posted losses. This severely impacted investors' sentiment. Investors will continue to focus on September quarter earnings, which will drive specific stocks movements. Therefore, investors need to be patient in the current market and focus on stock with strong quarterly earnings. Over the last 3 to 5 years, financial markets have delivered impressive returns, rewarding investors handsomely. Even portfolio that underperformed compared to benchmark, likely the Sensex or Nifty, likely still outpaced other assets classes. Indian stock market posted strong gains, with Nifty 50 and Sensex delivering 11 to 12% annualized returns over 5 years and 15 to 16% over 3 years. The mid cap and small cap indices outperformed, offering 12 to 20%. But as we celebrate these gains, Diwali 2024 brings with it an important reminder that we need to evaluate and refresh our investment portfolios. No matter how successful the past has been, the spirit of Diwali encourages us all to let it go of the old, stale, and non-performing elements, making room for a fresh start. A Diwali, a time to destroy the old and stale and a new start. Diwali festival celebrating a goddess Lakshmi, the goddess of wealth, is not only a time for material prosperity but also a time to cleanse and renew. Just as we deep clean our homes and remove the clutter, we should perform similar with deep cleaning our investments and portfolios. However, beware of the common traps most investors fall into when reviewing their holdings. Let's know how not to clean the portfolios. A common misconception among the investors is to hold on to the stock that have performed well and discard those who haven't. While this might work for trader, but it's not an ideal approach for long-term investors. Just because a stock has generated a high returns doesn't mean it remains a good investment. And conversely, poor past performances doesn't always mean the stock lack future potential. Deep cleaning, when we talk about the deep cleanings is meant to be in the scientific way, inspired by scientific investing frameworks at Omni Science Capitals. Let's explore these critical pitfalls. We have some three evil steps or three evil stocks. For the first one is the capital destroyers, the second one is the capital eroders, and the third one is the capital imploders. that can hold back your portfolios. How to identify them, we'll talk about one by one. The capital destroyers are the companies that continuously generate losses or rare burdened with unimaginable debt, while some sectors like infrastructures are exceptions. Most businesses with consistently negative earnings or excessive leverage are harmful to your portfolios. And how to identify the capital destroyers? We have some categorically some figures which they fall into, and we categorize them as the capital destroyers. For example, earning per share wouldn't be less than 0 over last 5 years. Debt equity ratio would be greater than 50%. Interest ratio will be smaller than 4. If you spot companies in your portfolio like this that meets these criteria, excluding sectors like finance or infrastructure, it's time to consider eliminating them. The second evil is the capital eroders. The capital eroders are the companies with no sustainable competitive advantages, bad management, or consistently poor returns on capital. Persistent underperformance in terms or returns on capital or returns on equity can indicate poor long-term prospects. How to identify eroders? The return on capital should be smaller than 10%. Return on equity should be smaller than 10%. If a company consistently fails to meet these thresholds, it's likely erodes value over time, removing them from your portfolio and helps prevent long-term drag on performances. The third and last one is the capital imploders. Capital imploders are the trickiest to identify because they often evolve excellent companies that are overvalued. These businesses may have strong competitive advantages, but if price you are paying is far above the company's intrinsic value, you are setting yourself up for disappointment. Overvaluation can lead the capital implosion where investors face steep losses despite holding a great business. Price to earning ratio would be greater than 50 or in some cases 30 to 40. While exception exists like a company having a anomalous low earnings per year, it's important to be cautious if a stock appears grossly overvalued. Even it's a household name or great business, consider exiting the position. And what to do after eliminating the evils? Once you have weeded out the capital destroyers, eroders, imploders, you will likely have freed up your cash. The next step is to invest wisely in companies that don't carry the same pitfalls. Again, using the scientific investing framework, here are some guidelines for identifying robust companies. For this, we again have some categories or some figures and values to identify robust companies. Especially EPS rate will be greater than, the earning per share will be greater than 0 over last 5 years. Debt equity will be less than 50%. Interest rate will be greater than 4. Return on equity will be greater than 15%. Return on capital will be the same as equity, 15%. Price to earning ratio smaller than 25. Revenue growth greater than 10% over 5 years. Create a diversified portfolio with 20 to 30 stocks spread across 4 to 6 sectors, ensuring that no recent developments have weakened these. So refreshing your portfolio for Diwali 2024, because Diwali is not only a festival of light, but it's also a time for cleansing and renewal both in our homes and our investments. By eliminating the 3 evils of capital destroyers, eroders, and imploders, you can rebuild a strong portfolio, setting yourself up to. For now, as always, at the end of the video, we have some stock recommendations. We have 3 stocks here for recommended stock. The first one is AI Champ. AI Champ demonstrated the stable financial performance with continuous growth in the revenue and profit, indicating that its business model is effective and market demand is strong. Additionally, the company increasing market share is core market reflects its enhanced competitiveness and brand influence. The strong management team with extensive industry experience lays a solid foundation on future development. Through continuous investment in research and development, AIChamp new products and service further strengthen its competitive edge in the industry. The company's regular dividends and stock buybacks plans have increased earnings per share and boosted investors' confidence. The second one is the Timex here. The Timex shows a great investment potential mainly due to its stable performance growth and strong brand influence. The company's sustained profitability not only enhances investors' confidence but also provides an advantage in highly competitive market. Moreover, Timex excels in innovations, continuously launching new products that meet market demands, especially in the fashion and in the smartwatch sectors, which is particularly important. Its reasonable dividend policy also had appeal for long-term investors with the rise of consumption upgrades and the emergence of young consumer groups. The brand market expansion strategy will further drive revenue growth, offering a considerable development potential in future. Overall, the Timex is the key investment target worth focusing on. And the third one and the last is here the global international carriers. The global international carriers has shown stable performances growth, reflecting effective cost control and operational efficiency management, which lays the foundation for its long-term development. The strong recovery in the market demand, particularly due to increase in global trade and logistic demands, further enhances the company's growth potentially. Additionally, a healthy financial status not only ensures the company's short-term financial resilience but also supports its debt capacity, demonstrating a good financial management. Therefore, combined with its optimistic industry outlooks and proactive strategic partnership, global international carriers present a high investment value and is worth investing in tensions for long-term returns. And this is it for today. And thanks for being with us till the end of the video. And everyone knows investing involves risks and decisions should be made with caution. Explore investment opportunities to inspire your journey. This guidance is intended to share perspectives with the final decision making authority resting with you. Stay tuned for more informative videos like this.